All right, let's do another video. It's still Friday. It is noon. We're seeing some decent movement today. We got the SPY up 0.5%, Dow Jones 0.17, NASDAQ up over 1%, Triple Q's almost at 1%. IWM's lagging like usual. And the XY slightly up, oil still holding above 90. Gold, nobody cares, they used to care. VIX is down 8% and bond yields are down as well. Let's dive into this video here. I want to talk a little bit today about the SP 500. Ever since we had the Fed decision and Powell's speech this week, I've seen a lot of negative sentiment online. I've seen quite a bit of negative sentiment online, so I'm in the minority camp. I think Jeffrey Gunlock was in camp with me, and I didn't think it was that bad. It was kind of what I expected, and certainly nothing jumped out at me. I know Steve Eisman, the guy from The Big Short, was on CNBC yesterday, and he says, why all of a sudden now are people believing the Fed that they're going to be higher for longer? Like, we've been doing this for over a year now. So markets sold off. Not sure how much of that is just seasonality with the quantitative tightening, or if it was actually the speech and what Powell was saying and what they said with the higher for longer rates next year. But at the end of the day, we're sort of in a negative seasonal period to get through the end of Q3. And then historically, October, November, December, the markets tend to do pretty well. There's a lot of data and sentiment that's positive on that. But there are a few things with the S&P 500 I want to look at from a technical standpoint. So we're going to dive into some technicals today. It'll be short. It'll be sweet. I think there's a few things to keep in mind when you're a long-term investor looking at the short-term TA, how that might play out, compounding that with other metrics, other macro decisions is going to help you overall as an investor. So let's dive in. Let's look at a few components of the S&P 500 and what it might be showing us. All right, notice I got my red light on in the back today because it's been a red couple of weeks. Let's zoom in on the S&P 500 here. Basically, I like to go to start on the weekly. Session disconnected, not sure what happened there. This will be our third negative week in a row. 2 weeks ago, we were negative 1.2%, then 0.5%, and this week was much worse at negative 2.3%. So there's a couple pieces. Gareth Soloway, who I follow, who I think is great, he's primarily a technical analyst. He's looking at this in terms of potential head and shoulders. And a head and shoulders is usually a negative chart formation for a stock. So a head and shoulders pattern is when you're going to have a left shoulder here, so you go up and down, and then you have the head in the middle, which is higher than the shoulders, usually broader, and then you form a right shoulder afterwards. And this is usually indicating weakness in a stock or an index. And how you can measure it is you can go and draw a trend line. Usually we want to connect the shoulder lines with the low points on the head roughly. And this is called the neckline. So the yellow line you see there is called the neckline. Now, looks like we already breached the neckline. So that could mean we're in for further downside. How you can potentially look at this is a measured move from the top of the head down to the neckline, and then you move that to where it breached through. So your measured move would be around 408. So we can move our white line up to that 408 level, and we'll mark that as our potential head and shoulders line there. So now that we're zoomed out, we can do something that's called a Fibonacci retracement. And the Fibonacci numbers are a sequence of ratios that are used in mathematics and charting to have significant points of movement. And so how do we look at this? So you can see that when we first came off our peak, we broke through this first Fibonacci line and we found support on what's called the golden ratio 618. We went back up, got resistance, briefly broke down, overshot the next line, and then finally broke through, chopped around a little bit, broke all the way down to the 236 line, bounced up to the 50% retracement, which is the 0.5. Again, undershot it, crawled way back up to the 618, all the way back down to the very bottom. Again, kind of chopped around. You can see a lot of movement around these lines used as support and resistance. And again, bounced back. We pumped on this 50% retracement for a while until we finally broke out, broke through the 618, back tested it, and then we broke up through the 786, got a retracement close to the 618, back up to the 786 resistance line, and now we're back nearing on the 618. So the question is our measured move from the head and shoulders is down at 408. That would be a move slightly below the 50% retracement. And so the question is, do we breach this 618 Fibonacci line in line with that head and shoulders move? And that would likely move us back down at least to the 50% retracement line. So another thing you can look at is just general support and resistance areas in a chart that have a lot of touch points. And this is an imperfect science, but if you look at the top white line, which is at 430, which is near where we're trading now, you just see a lot of touch points, a lot of the candles going through that line, bouncing around on those lines. You see a couple peaks here for resistance and then support. And that line is pretty much in line with our 618 Fibonacci, so that makes sense that that's where we're going to have a lot of support and resistance. The final couple things I look at are the RSI and the MACD. Here we have the RSI, which is the relative strength index. Generally speaking, if you're above 70, you're overbought. If you're below 30, you're oversold. You can see that the SPY doesn't get below 32 often. We did when we crashed last year a couple of times. Prior to that, it was in the 2020 COVID crash. And prior to that, we saw it in 2018 when they were raising interest rates. But as you can see, it's a generally ebb and flow, oscillating. As you can see here, we were running around 33. It's bounced up to around 35. So the whole point here is on the daily, we do have some room to run down. We're not quite fully oversold yet if we're going to see some more downside. On the weekly chart, this is more so getting major moves when we are getting to the 30 on the weekly. Those are usually like bear markets, pretty major moves. You can see in 2018 we didn't quite get there. Of course, back in 2009 we dipped well below and then again retraced in 2011. The other one was in 2020 and then of course last year. So here, if we're looking for a mild pullback, we're back bouncing off the 50 level. So if we breach below the 50 level and the RSI on the daily gets closer to the 30 level, then we're looking at more negative territory and getting into a more oversold conditions. And the last one is the MACD. I have the weekly up first here, and we usually see when the orange line goes above the blue line, that is a negative crossover. And they're both heading pretty steeply down. You've seen in the past when that occurs, it generally trends down. On the daily, we've not only flipped negative, I'll zoom in a little bit here. We've not only flipped negative, but we've also breached into negative territory on the MACD. So that's another indication of weakness. Of course, like we saw back in March 23, this can rebound and come back up, but it's something to keep an eye on. Last thing I'm really looking at is kind of this area where we have a gap over here. We have a negative gap in here, so you could see an overshoot into the upper 390s, which has sort of been a range. So basically, right now, we're down on resistance. If we get a drop to that head and shoulders retracement level, we'd be about a 5.5% drop. If we get into around 395 level, you'd be looking at an 8.5% drop. So what's the overall purpose of this? Again, I don't use TA specifically for day trades, swing trades. I'm more of a long-term buy and hold type investor, but with negative sentiment, with seasonally negative time of year, we might expect a little bit more of a pullback from here. We'll wait and see if that head and shoulders pattern plays out, see how the RSI and the MACD trend over the next week or two, and that might help bring in some more buying opportunities for long-term purchases that are a little bit cheaper than maybe putting all your money to work right now. If you're a newer investor and you are following people on Twitter, don't think that when they're saying it's bearish or bullish that they're necessarily using all their money to buy in, sell out of the market constantly. Most people have a large percentage of their money put away for long-term investing, and when you're doing tactical trades or making tactical calls on trades, generally using single percentage points of your portfolio. So just keep that in mind. If you are newer, you have a smaller portfolio, don't get too stressed about that. Dollar cost averaging is good. Time in the market's always going to outperform timing the market for 99 out of 100 people. You can use it as a tactical opportunity on how much money you want to deploy, depending on levels in the market. But for the majority of us, we want to just continue to put money into the market over time and let it grow. All right, so that's all I have today. That's the S&P 500, a little bit of a technical analysis on that. We'll see how things trend out over the next week or two. Thanks so much for watching. Hit the like button, subscribe if you're enjoying these videos so far. Please comment. We'd love to hear what you think, and we'll catch you in the next video.